Hi, welcome back to part 3 of my investing guide. Which safe asset classes do you really need in your portfolio? I already written and published the article on Medium, so I'm just gonna read it to you and maybe add a comment here or there and guide you through it. When it comes to building wealth, most people focus on the exciting part, chasing returns with stocks or ETFs. But the foundation of any strong portfolio is the safe portion, the money you can count on no matter what happens in the markets. In this chapter of my investing guide, we will explore the most reliable asset classes for protecting your savings while keeping them liquid and accessible. This is part 3 of my investing guide. You can also read it as a standalone article or, in this case, watch it as a video. In part 1, I explained why most investors should use ETFs as the backbone of their portfolios. In part 2, we looked at the Level 1 asset allocation, short L1AA. How much of your portfolio should be in risky versus safe investments? If you haven't watched these videos yet, I recommend you to check them out. If you imagine our portfolios in two buckets, one for safe investments and the other for riskier ones, in this chapter 3 I will talk about which asset classes we should use to fill them up, besides globally diversified ETFs on the world economy. In this part 1, we will cover safe investments, the backbone of our portfolio. The safe portion of your portfolio. Safe assets should be secure and liquid. For many people, this means keeping money in bank accounts. Bank accounts and deposit insurance. In the EU, the European Deposit Insurance Scheme protects deposits up to 100,000 euros per person per bank. If your bank were to fail, other European banks or governments would, at least in theory, step in to safeguard your funds. Choosing a trustworthy bank makes it unlikely you will ever face this scenario. But the risk is never zero, even for large established institutions. Keep in mind, only balances up to 100,000 euros per bank are covered, and if you hold more than that in a single bank, it's wise to spread your money across multiple banks. While the scheme has never been tested in a major crisis yet, the risk of failure seems very low for most private investors. ChatGPT was very helpful in providing an overview of deposit insurance schemes worldwide. I reviewed many of the sources and the information appears to be accurate. If you are particularly interested in a specific country or region, let me know. I would be happy to double check and verify the details for you. Yeah, here we can see United States, for example, 250,000 US dollars, United Kingdom, 85,000 pound for now. Yeah, Europe and the countries mostly 100,000 euros, even though like many countries like Germany, they have the 100,000 euros secured through the EU, but they also have like their own additional insurance schemes sometimes worldwide as well. And yeah, Switzerland 100,000 as well. Yeah. Okay. Further on, call money accounts, in German also called Tagesgeld. If you're holding larger sums for a while, consider a call money account, sometimes called a savings or demand deposit account. These accounts usually offer higher interest rates than regular checking accounts. Transfer to your main accounts are often quick, sometimes even instant, if both accounts are at the same bank. If you have your main account and a call money account at the same bank, they will both count towards the maximum insurance scheme amount. Be cautious of offers that seem too good to be true. Sometimes high rates are temporary promotions. Some banks offer unusually high rates, maybe located outside your jurisdiction, and check if they are covered by deposit insurance. In extreme cases, high rates could signal a bank in financial distress, something you will definitely want to avoid. Call money accounts typically won't make you rich, especially with a modest portfolio. The extra interest might only amount to a few euros per year, but they are still a simple way to earn a bit more on your safe money. Bonds and bond ETFs. Another option for the safe portion of your portfolio is high quality bonds. To meet our safety and liquidity criteria, only consider bonds with at least a BBB or Baa3 rating, bonds dominated in your home currency, and short-term maturities. I take these recommendations from Comma 2025. For maturities, he gives example ETFs and funds up to 3 years as examples. Since diversification is key, it makes sense to invest in an ETF or money market fund, which spread risk across multiple bond issuers. If a bond within the ETF is downgraded, you also don't need to worry about adjusting your portfolio yourself. And here's an overview of the bond ratings from Moody's and Standard & Poor's from Investopedia. Yeah, here we can see AAA, of course, is the best. Then it goes down. Next one is B, BBB, and then after that is C. And for Standard & Poor's, they also have D. And yeah, anything like this are considered investments, but under BBB, which is not recommended for the safe part of the portfolio, yeah, they are also called junk bonds. What does maturity mean? In the context of bonds, maturity refers to the date on which the bond issuer is obligated to repay the investor the principal, the amount originally invested. Until that date, the bond typically pays the interest, the coupon. A short-term maturity simply means that the repayment is due relatively soon, often within 1 to 3 years. Shorter maturities generally reduce interest rate risk because your money is tied up for less time and the bond's price is less sensitive to changes in market interest rates. Bond ETFs are also practical if you have large cash reserves. For example, if your safe portfolio allocation is 1 million, holding everything in insured bank accounts would mean opening 10 accounts with 100,000 insured per account. With a bond ETF, you can manage that allocation in a single position. Holding cash at home. Why not keep cash at home? While it offers instant liquidity, it comes with risks. For most investors, these risks outweigh the convenience. That said, keeping a small amount of emergency cash at home can be useful. During a financial crisis, banks and brokers may temporarily restrict withdrawals. A few days' worth of expensive in cash can provide peace of mind. But storing large amounts of cash at home is rarely wise. Summary: safe asset classes. For the safe part of your portfolio, you can consider first, bank accounts, your default option, but keep balances under the insured threshold. Second, call money accounts, to earn modest interest while maintaining safety and liquidity. Keep in mind that they add to the insured threshold. Third, bonds or money market funds, especially useful for large reserves. And four, small amounts of cash at home, an emergency backup. For most private investors, call money accounts strike the best balance of safety and return. Bank accounts are fine but don't exceed the insured limit. Bond or bond ETFs make sense for wealthier investors managing large sums. Yeah, and that's about it. If you have any questions about this topic, then just ask them in the comments. And also, if you have some questions or are interested in another specific topic, you can let me know as well. And I think, yeah, next video I will try to upload it starting next month or in the middle of next month. So if you want to get updated for that, then yeah, please subscribe. And yeah, for the next article, we are gonna look at the more interesting choice of, what should we put in the riskier bucket of our portfolio. Yeah, and with that, here should be another video that is recommended to you by the almighty YouTube algorithm. Then see you.